Before we begin, it's my pleasure to introduce our speaker for today, Jose Blasco. Formerly, Jose was an engineering professor in Spain. He's also an award-winning trading instructor. Jose is a multi-asset and a strategy trader who trades globally. Besides that, he's also a quantitative researcher where he produces commentaries across different markets. He develops advanced trading models and implementing hybrid and algorithmic trading systems. He's the founder of Predictive, which have been developing patented trading technology and teaching clients on this trading technology. So without further ado, let me pass this presentation over to Jose. Jose, the floor is yours.
Thank you very much, CY. It's always a pleasure to be here. It's always a pleasure to welcome everybody to the session. And it's always a moment where I become a little shy when you introduce me always so kindly. So thank you for that. I am now getting ready to share my screen. And while I'm doing that, I would like to have another confirmation if that's okay, that sound is okay. I believe all should be good, but just to make sure that my microphone is also working well.
Yes, everything is well.
Wonderful. This is great. Okay, well, so let's begin. We have a lot to cover in today's session. Again, the title of the webinar is. Give me a second. I have a little thing on my screen here. Here we go. It's order flow dynamics, leveraging direct and indirect forces in FKLI and FCPO futures. So, of course, I would expect that we are a diverse group of people attending this webinar, where some of you may have tons of trading experience, maybe interested in trading other products. Some of you may have tons of stock trading experience, but maybe less with futures. Some of you may be totally new to trading. And again, probably there are many different cases, which is anywhere in between. So in this webinar, I will get a bit advanced at times, but at the same time, I will keep things fairly simple, and my approach in trading, my approach in this educational session will be indeed very pragmatic. So you will see some definitions that will be very simple and easy to understand and to follow, that potentially will help your understanding of the markets, and therefore ideally impact your performance or give you some aha moment. That would be my intention. Okay, so I'm just going to conduct the webinar. And as said, later we'll have a Q&A session, and I am looking forward to those questions. I'm sure there will be a few. Yeah, so let's begin. Okay, so as always, as we get started, we have a disclaimer that is always the case with financial presentations in the financial services industry, isn't it? Of course, I assume, I understand, and very likely all of us are very serious people, and therefore we have a great respect for the marketplace. There are plenty of opportunities, but also there is risk. Okay, so obviously trading education, control over emotions, control over risk management, it's absolutely key. And therefore, everything I'm going to discuss in today's webinar are some of the techniques that I utilize myself. It's real possibilities to be applied to the real world of trading. At the same time, it's always recommended that you guys go ahead and backtest, go ahead and practice those methods, so you end up with a trading plan with specific rules, a specific rule set that then you follow, so you can become systematic. Okay, and systematic basically means that you produce consistent action, which that needs or should provide consistent results. Whereas if you were to improvise every trade or trade based on emotions, and every trade is different, obviously there is no consistency in the action, and then the results would very likely be all over the place, isn't it? So anyway, so let's begin. The agenda today will be a quick speed of the light introduction, because this is about you, not about me. We'll then get introduced to order flow. So what is order flow? And then we'll talk about the concept of direct and indirect forces, which will be a very simple thing to understand, but at the same time, at least when I learned about this myself, extremely eye-opener and very impactful when it comes to how to think about the markets and how to trade them. Then, most importantly, our job is to add odds in our favor when we trade. The future is never a sure thing. The future is out there to happen, and anything could happen anytime. So we manage our risk, but while we manage our risk, we want to expose ourselves to what a high probability situation could be. High probability doesn't mean guarantee, but it means odds in your favor. So we will learn about direct forces and indirect forces, and most importantly, we will learn about combining them. So if direct forces are helpful and indirect forces are also helpful, why don't we combine them together so we can have potentially more powerful trades? That's the idea, that's the concept. And I'll use some slides, not too many, to go over the, let's call it the theory. And then from there, we'll move into a live demo where we will put this into practice using real-time charts. Of course, most of the markets at this time of the day are closed, but still, at least we'll be using charts and, charts in the present. So you can observe what we learned today into tomorrow and so on. Okay, and as I said, also Q&A. So introduction, again, speed of the light, really, it's all about trading. This is my life. And trading means that, I execute the trades, but also I look for the market opportunities. Hence, I do a lot with my technological background, as well as everything I know about quantitative finance and modeling and machine learning and AI and all of those things. So markets are a very dynamic machine. And again, it's all about having, as I said earlier, really, it doesn't matter how you came up to there, but what matters is that you have a method and you are systematic on its application. So that's what I do. That's my bread and butter, and I think that summarizes it all. So let's begin with the lecture, okay? So the first thing I would like to discuss and make sure everybody understands is what is order flow, okay? And order flow refers to the continuous process by which buy and sell order, those are order tickets. They keep coming in and out of a specific market. In other words, we are now sitting on a chair, on the sofa, at your desk, wherever you are. And as we speak, there are millions of people, literally millions and millions of people connected to the internet around the world. And some of them trade. And the ones that trade may be clicking the buy button. And some of the other ones that trade, they may also be clicking the sell button. And the moment they do that, order tickets are created and they travel through the internet, getting into your brokers, and from your brokers, they are then routed to the exchanges, right? Bursa Malaysia in this case. So what happens? Well, of course, those tickets go in there, and then depending on finding a valid counterparty, that means for each buy order, you may or may not find an equivalent sell order. For each sell order, you may or may not find the equivalent buy order. So depending on finding that valid counterparty, those orders would be either executed and the buyer bought because the seller sold to the buyer, or the seller sold because the seller was able to find a buyer who he could sell to, right? So hopefully I didn't say that too fast. But basically, if that counterparty is found, then the order that traveled through the internet is executed. And the moment it's executed, it's gone. Now, if it's not executed, it's going to stay there. And two things may happen. A counterparty comes in a bit later and the order gets executed. Or no one is coming in at that price. Okay, maybe someone wanted to buy at 50 and the price of the asset you wanted to trade is 52. And that person is willing to buy at 50, but the reality is that the price of the asset is 52. So no one is selling at 50, given the fact that the current price is 52. So that person who wanted to buy at 50 is waiting and waiting and waiting. And maybe after a while, that order to buy at 50 is canceled. Okay, so it's all about finding the counterparty or not. And finding the counterparty has to do with the same price, right? And the same quantity, or at least some quantity, right? If you want to buy 5 futures contracts of FCPO and you only find someone who wants to sell 3 at that price, well, you will get filled on 3. You will have a partial fill, but you will not get fully filled. So then you need to wait extra until the other contracts hopefully get filled, assuming a counterparty is found, okay, which may or may not be the case. Anyway, I'm saying something quite obvious, but again, I want to make sure everybody's thinking about the mechanics of what I am saying. That's why I'm taking my time, because later we're gonna take it to the next level, and I would not want that we are making assumptions, because what I'm saying is so simple and so obvious and so intuitive that we may not think enough about it. I don't want us to overthink about it, but at the same time, I want us to understand the details of what I just said, because in a moment, I'll take it to the next level. So, from a terminology point of view, the orders that were executed because they did find the counterparty, we call them field orders. Executed orders could also be called field orders. We normally refer to them as FOs. Whereas the orders that are still waiting to be executed or canceled, because they may not be executed if there is no counterparty, the trader may cancel the order. So those waiting orders, they are waiting to be filled, and therefore we call them on-field orders, which I like to use the acronym UFO. Okay, so we have buy UFOs and we have sell UFOs. We have buy on-field orders and we have sell on-field orders. Okay, and at this moment in time, I mean, I know we have a Q&A for you to ask me questions, but if you don't mind, actually, I would like to be the one asking you a question at this time. And the question is, what is more relevant to you? What do you think is more important? The field orders or the on-field orders? Which type of orders would you say, would you think, would you picture as more important? So please use the chat box to respond to this. It's either field orders or on-field orders. You can type FO or UFO. Which type of market information would you reckon is more relevant? The field orders or the on-field orders? Okay, and I can see some of the responses kicking in. So we have UFO, FO, UFO, FO, 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 UFO, UFO. So a little bit of a mix, right? A little bit of a mix, okay? And again, of course, I will give you a proper answer in just a minute, okay? But I just want you guys to start thinking about it, because like many things in life, okay, certain things are counterintuitive, right? And once explained, it's like obvious, right? But at the same time, if you are not explained about it, sometimes it's counterintuitive, okay? You know, sometimes it happens that you try some food and, you know, you feel it's, you know, it's, you know, maybe you feel it's so sour, and next thing you know, that food actually has a lot of sugar, and you're like, how can it can be sour if it has a lot of sugar? So again, if you knew the recipe, you would totally understand, but if not, you may be thinking it's sour, where actually is very sweet, right? So a bit of the same thing, and not sure if this is a good analogy or I'm getting anyone hungry at this time of the day, putting the very bad humor on the side. It is very important that we understand the mechanics from behind the scenes. Okay, so I will answer your question in just a moment, and I want to thank you very much for your participation, and please keep working with me on that, so the webinar will be more impactful to all of us. Okay, so now for a moment, let's pause here, and again, I know I haven't answered the question yet. I will come back, but let's talk about direct forces and indirect forces, because as I go through these definitions, you know, basically we will get to understand the right answer to the prior question. So the first thing I need to do is I need to read the first paragraph on this slide, and then I have another question for you all. So the first paragraph on the slide says that there are many forces that may impact a market, such as news, reports, fundamentals, technical factors, etc. So I want to take us all back to something that happened many years ago. To be honest, it's not a happy thought. But I want to take us back to that particular market situation because it's real, because it truly happened. And I'll explain a bit more later why exactly that one. And the situation I'm thinking about is the tsunami in Japan that took place many years ago. That was a complete disaster, with the nuclear plant in Fukushima getting flooded with water, and then nuclear radiation came out on top of the craziness that took place with the tsunami. And well, I'm not gonna use more adjectives to describe how crazy and problematic and very sad that situation was. Okay, so sorry to bring this kind of like dramatic situation to the webinar, but again, I'm doing it for a reason you will understand in just a second. So here is my question. Question for everybody. Do you think that an event like the tsunami in Japan that happened a few years ago has the power to impact the Japanese market, the Japanese yen, et cetera, et cetera? Do you think an event like that has the power to impact the markets? Yes or no? What would you say? What would you say? And in this case, I guess it's a pretty obvious question, I would think. I'm guessing I'm going to have yeses everywhere. I'm not going to have any no in this case, isn't it? That's what I'm seeing, right? Everybody says yes. So again, thank you for your engagement. That was a very obvious question. But here's why I'm asking. Here's why I'm asking, okay? And listen carefully to this, because this is something that often is not understood or people don't think about it. So let me rephrase the question. Okay, let me rephrase the question. Do you think the tsunami in Japan has the power to move the Japanese market and the Japanese yen and even the global markets if the tsunami in Japan happened over the weekend while the markets are closed? What would you say about this variation of the initial question, where I have added, we still have the tsunami in Japan, it's crazy, it's real, but the market is closed because it's over the weekend? What would you say now? Has the tsunami the power to move the market, yes or no? Okay, so I'm just waiting to see your responses. It is not a tricky question, even though maybe I'm phrasing the question in a way that is not so common. Okay, when you turn on the TV and you listen to financial news, typically they don't tell you, and the market was closed over the weekend. Okay, they basically explain to you what happened after it happened, with whatever theory behind the scenes. Okay, here we go, and I'm glad to see that now we have a little bit of diversity on the answers, where some of you said no, right? No. Okay, and you know what? You guys are both right. The ones you have said yes and no and delayed, all of you are right. Okay, and here's where the subtlety comes in. Let me explain why yes is right and why no is right. Okay, and at the same time, by doing that, we will kind of answer what's more important, the field or the on-field orders, right? So look, markets only move when the trading session is open, and this is because orders can only be executed during market hours. Even though the tsunami in Japan was real, which is, by the way, that's why I picked the tsunami in Japan, because you could argue that if instead of the tsunami in Japan, I talked about some other news, maybe it's fake news. Maybe it's a news that is manipulated. Maybe it's an economic report, such as the unemployment number. And normally those economic reports, after they are reported live, after a while, they are then recalculated, and maybe some corrections are posted after the fact, maybe 1 or 2 weeks later. You could also argue, when it comes to all sorts of market news, that large market participants that have access, for example, to Bloomberg terminals and other sources of information, putting on the side insider trading, some market participants may have access to that information ahead of time. So again, that's why when it comes to the tsunami in Japan, there is no interpretation, right? That's why I use that example. It's a real news. We all know it. It's real. It was real, not a joke. It was bad. No one could say the tsunami in Japan actually was a good thing for the economy. No one is going to say that, because it was terrible. It's a negative news. Everybody in the world agrees. And therefore, when I ask you this question, can the tsunami in Japan move the market when the market is closed over the weekend? The answer in one hand is obviously yes, but on the other hand, the market cannot move over the weekend. So the answer is no, because orders don't get filled unless the trading hours are running, and therefore the buyers can find the counterparty seller and get those orders filled, or the seller find the counterparty buyer and get the orders filled. So markets cannot move unless the market is open, and the reason why that's the case is because during the market, while the market is closed, no orders are being filled. Of course, the ones that said delayed, gap down, etc., you are right. Of course, you are right. What's going to happen is that over the weekend, as the real news is happening, orders that were in the market waiting to be filled, right? UFOs, right? Orders that were waiting to be filled would likely going to be canceled and replaced. Maybe buy orders are canceled and replaced with sell orders, or maybe sell orders are added on top of the sell orders that existed. Whatever that is, the order flow would have an impact. And when the market opens, the orders get filled, and now you see the market moving. So now we get to the point of what's a direct and indirect force then. Okay, and I believe this is sensible thinking. Putting on the side that there are different ways on how to think about the market, and the market is the boss, not me. Not any market guru is the boss. The market itself is the boss, isn't it? So putting on the side that there are many theories and many ways on how to think about trading, and many schools of thought, fundamental, technical, all sorts of things, and many approaches are totally valid. If you follow my explanation, if you were to work with me on this terminology, sensible thinking would imply that the flow of orders entering a market is the one force we should call direct, because it's the force which is responsible for movement of price. No orders, no movement. Orders are in the market, but the market is closed. No movement. Orders are in the market, and now the buyers find the sellers find the buyers. Orders get filled. Now you get movement. So if that's okay, let's call that flow of orders entering the market, let's call that the direct force. And I'm not saying direct is more important than indirect, but I'm calling any other reason, I'm calling it indirect force, because they may or may not impact the market the way you think. And in the end, the tsunami in Japan, if you think from a direct and indirect, just if we were to go to the English dictionary and we look at the definition of direct and indirect, then the tsunami in Japan is an indirect force. I'm not saying it's a small force. It's definitely real and powerful. But what the tsunami in Japan did is not to move the market. What the tsunami of Japan did is get people to change their orders, maybe add many sell orders, that then when the market opened, the market moved, right? So the direct thing, if you wish, that the last step in the chain is the orders getting filled, leading to price movement. That's the direct force. And anything else that led for the orders to be there in the first place, which could be earnings reports from a stock, could be change of dividends of a stock, could be the unemployment number, could be a new GDP figure, could be a tsunami in Japan, could be the beginning of a war. All of those things could be technical factors, could be an oscillator hitting oversold or overbought, could be a breakout of a support or a breakout of a resistance. Again, you name it. All of those things which are real and definitely very, very, very powerful. In this, my definition today, I'm calling it indirect force. Since all of that, without the orders getting filled, lead to no price movement. Okay? So again, a bit of an intense conversation here to start the webinar, and hopefully you are with me on the rationale of what I'm presenting here. Again, 100% respect to all the various theories out there in the marketplace. I'm not even calling this a theory. I'm just basically being very pragmatic at how I packaged the various elements that move price. One type of elements, I call it direct force, and everything else I call it indirect force. And the reason why I'm doing that is because later, when it comes to trading, I will want to line up direct and indirect forces together. So then I take trades at that time. So that increases my odds of success. Okay? Just moving in that particular direction. So let me know on the chat box, how you feel about this initial. We'll have Q&A at the end, but please feel free to let me know if this has been a bit confusing or actually you feel I make sense. Which, I wouldn't be surprised if I have a little bit of a mix of opinions on the chat box, because again, we all have a slightly different way to think about the markets, and that's fine. But again, I would like to open your mind, if I may suggest, to thinking in those terms, at least until the webinar is over, when I get into the real-time charts and you see this in action, and hopefully it will make sense to you. Okay, so please let me know in the chat box if so far I confused you or you are comfortable with this concept. So let's continue. Okay, I'll be reading the chat box in just a moment. So indirect forces, using this very pragmatic approach to thinking about market forces, is news, it's reports, it's fundamentals, it's technicals, it's anything. But the problem with them, and this is another reason why I'm calling them indirect forces, which again, indirect forces, I know the word may make you feel that indirect is less important than direct. It's not the case. To me, they are just equally important, direct and indirect. But there is a disadvantage with indirect forces, though, which is the fact that indirect forces are subject to interpretation. So, of course, the tsunami in Japan, okay, everybody in the world agrees is bad. But what about the unemployment number? What about the inflation values? What about the fact that a stock raises or lowers dividends? Again, there are certain things, right? What about some figure reported related to palm crude oil? There are certain things that would require some interpretation. And, the problem is that the interpretation that matters is not going to be our retail traders' interpretation. The interpretation that will matter will be the one from the large market players. And the reason why that would matter is because they may add or remove orders given the news, given the report, given the fundamentals. And the problem is that we may or may not interpret that market news in the same manner. Okay, so I'll look at some examples in just a moment. But for example, here's a little flash of an economic calendar. So yesterday we got exports year over year was reported as 16.9%. The expectation was 9. The prior was 3.9. Well, some people will look at this number as it's better than expected. Some people will be like, well, it's too good to be true. It's too much. It's oversold. I don't know. Again, these numbers imply an interpretation. Okay, the tsunami in Japan, everybody knew it was a bad thing, but that's why I use that example. But almost everything else require that interpretation. And the problem with interpretations is that they are subjective by definition. So it puts the smaller market players at risk of being on the wrong side of the market just because to you see that number is, wow, it's amazing, 16.9%, I think it was, right? Let me double check. Yes, 16.9% export year over year. That's amazing. Where maybe the large market players are like, well, we already kind of knew this market in advance. Technical analyst, reported it was expected to be 9, but the large market players, I'm talking about the largest bank in the country and the traders that may not be market analysts, right? So they may have a different view given the fact that they are connected with the market at a deeper level. And I'm not even talking about insider trading. I'm not talking about anything illegal here. I'm just talking about the fact that, just like in any industry, you have the wholesale players and you have the retail players. And, of course, if you work in the wholesale side of any business, in this case, financial services, of course, you got contacts, things, you connect with things, you have market data, access to market data that not everybody has, including market analysts, okay, which may be financial advisors and things of that sort. So respect for everything, but let's be realistic. Interpretation could be subjective, okay? And I'm just raising a little flag there, which later I'll show you how to fix, okay? So we don't get in trouble. So furthermore, large market players often have access to this type of information ahead of time, okay? This could be a disadvantage, not always. And again, I'm not talking about anything illegal. I'm just saying it's a consequence of being a large market player, okay? You may be the one producing the data, actually. So that happens. And therefore, indirect forces are indeed powerful, super powerful. They are the reason why the orders are there in the first place. Okay, so they are very powerful. But the problem is that, that interpretation and that possible delay on gathering the information compared to other market players may create a little bit of a problem. Planning trades exclusively on that. Like, for example, the new GDP number is good, let's buy, right? So if you were to take trades just because of that, it would often lack consistency on the results because of all these factors. Okay, so again, as you will see in a moment, my approach would be to combine the direct and the indirect forces. So let's take a look at indirect forces in action. Okay, so here we have a chart with FKLI. This is a daily time frame of FKLI. So each of those candlesticks are 1 day of trading. And at the time of the screenshot, that was December 20, just a few weeks ago, the inflation rate was reported at 12 p.m. Okay, the prior was 1.9. Everybody expected the number to be 2.1, meaning that there would be more inflation. So it was going to be bad for the economy, isn't it? And next thing you know, the number that was reported was better than expected. And not only better than expected, better than the prior number too. So, I mean, that is, if you were to have a regular, standard, common sense interpretation, you would say that's good, right? But what happened to the market? Well, the inflation rate suggested that everything was set for a move up, and it did happen as predicted. So from the bottom part, that was December 20. Okay, so you can see December is here. The ending part of December is more or less there. So that was the origin of this move up, where if you're a market analyst, you may blame it on the inflation rate that was reported as better than expected. And suddenly that indirect force created a lot of new buy orders and the markets went up. So again, indirect forces are indeed a powerful thing, but sometimes the opposite happens. I'm sure you have seen, if you trade the markets for a while, and again, I assume that some of you are new to trading, so everybody may not have seen this before, but if you have traded for a while, and please comment on the chat box, feel free to comment yes or no, if you have seen this or not. Sometimes you have a good number and the markets go up. Sometimes you have a good number and the market goes down. Sometimes you have a bad number and the market goes up. Sometimes you have a bad number and the market goes down. And it's like, I mean, what just happened here, right? Why? Okay, and why, again, I guess that there is a why for each of the cases. And to be honest, who knows sometimes? Sometimes the market moves in a specific manner and we don't know exactly why. Maybe because some very large market player knew the number ahead of time and that was already totally priced in. So they took profits instead of entering trades, they exited trades at that time and the market moved in the opposite direction. That's a common action, but you never know why. I mean, unless you work for, Maybank Investment Bank or Afin Huang Investment Bank or RHB Investment Bank or, one of those guys. And I left a few names that, of course, are just as relevant. So I did not mention them. So unless you work from those guys, probably you may have a theory about why, just like you had a theory about why the number was good or bad. And the fact is that everything was an interpretation. And again, if you manage your risk, if you have stops, if you use contingency measures, if you maybe close the trades or reverse your trades, or I'm not sure what type of risk management you use, but if you have some risk management in place, you could still be okay. But many times you would be like, why? That was very obvious a good news. That was very obvious a bad news. And the market just slapped me on the face. Sorry for the expression, even though this is a commonly used by traders expression, right? So why? Okay. So again, instead, okay, what about we think about these opportunities differently, right? So again, going back to direct forces, we said that movement of price occurs when orders change status from on-field to field orders, no matter what the reason why those orders enter the market in the first place. So instead of caring about why the orders are there, which of course is interesting, and if you knew, it gives you more odds. But instead of really truly caring and only trading if you know why, which, let's be realistic, most of the times we will not know why a move happens. We may have a guess, or they may give us an explanation on the TV, okay, typically given by a reporter, which by the way is not a trader, with all respect for reporters. They may not even know why. They've just been told to, basically that's their script. So instead of working too hard on the why, okay, why don't we look for on-field orders? Okay, having a way to identify on-field orders before they get filled, and that's the answer. On-field orders are more important than field orders. Why? Because field orders got filled already. So whatever power they have to move the market already happened, because the orders have been executed already, and when they are executed, they are gone. Whereas the on-field orders are still there. So if you have many buy on-field orders waiting to be filled, the moment those huge amounts of on-field orders to buy get filled, that will create a lot of power to move the markets to the upside as they get filled. So you have to identify those orders before they get filled. Okay. So if you had a way to identify those on-field orders, it would allow you to capture market movements without subjectivity. There will not be a need for interpretation or understanding the why. You will just need to understand where are the buy orders, where are the sell orders, where is the order flow. Okay, where are the buy UFOs, where are the sell UFOs. So small and large pockets of UFOs are always available in the market. The ones, as a trader, we care the most about are the large piles of orders. That's what we care about, because a larger pile of order will potentially work more often, will potentially produce longer lasting moves, longer lasting moves means that you get better reward to risk ratios. So your trades are 3-to-1, 5-to-1, 2-to-1, 10-to-1 instead of 1-to-1, right? So you want a great imbalance between buy and sell orders. That's what you want to find. And that's what we're looking for. So now, what is required to identify on-field orders? Well, it's not the chart analysis. To identify on-field orders, we need technology. Okay, there are multiple types of technology that allows to scan the markets like an X-ray machine and conclude where the orders are. Okay, I'll mention a couple of technologies. There are more in the market. You feel free to do your research as well. But one technology, for example, would be technologies that look in the book. You may have heard this term before. Okay, some traders even call themselves book traders. Okay, so they are looking at the book. The book means basically, and typically your brokers, as long as you have a good trading platform, they give you access to see the book. So you get to see the current level in the market, and you get to see a few levels down, a few ticks below, and a few ticks above. And you get to see how many buy orders are waiting to be filled below price, how many sell orders are waiting to be filled above price. So many brokers give you access to that information. Okay, many brokers. Again, I will use some real-time charts in a moment. Let me flash something here so you get to see this. You may have seen tools of this characteristic. We call this a dome, right? Depth of market. So you have multiple levels where in this case, this particular market is closed, so we don't see much, but you can see there are 3 buy orders waiting to get filled at 73, 4 buy orders waiting to be filled at 73.5. Okay, I'm using TradingView, by the way, and the market I'm loading here is FKLI, which is a Bursa Malaysia stock. Okay, so again, different markets depending on the market makers available, depending on the time of the day. I'm switching to FCPO. We'll be able to show these differently. Okay, so here we got 3 contracts waiting to buy filled, 21 contracts to sell, 6 contracts to sell. You can see this is dynamic and it moves. And of course, at this time of the day, the speed of movement is very, very low, given the fact that we are conducting this webinar in the evening. But you can see a little bit of a representation of what I'm saying here. Okay, now, while this is very visual and I love it, and I have to bring it to you. So you have this type of software, which is built in free trading platforms like TradingView and any more serious platform for sure as well. You have particular tools or platforms that are specialized on this type of information that will plot it for you on the charts in a way that is very visual and is very cool. Okay, but the problem by looking at the book, okay, while the book is indeed order flow, the problem with looking at the book is that it changes very fast. It changes very fast, and you may only see a few levels. Right now, at this time of the day, you only see one. It also depends on what type of market data you have subscribed to. With your broker, it may give you different choices of the market data and also different level of cost. Okay, but even if you had full visibility of the book, again, let me go back to what's the problem with that. The problem with that is that the book moves very fast. So if you are a technologist and you have programmed an algorithmic trading methodology that buy and sell where the buy and sell orders are in the book, and you have taken your development, your software development, you have taken that to the same data center where Bursa Malaysia got their exchange co-located. So then you would have your computer just a few meters away, connected with a fiber optic with very little latency, and you could place buy and sell orders based on the book. And believe me, very serious traders do that kind of thing, and it's very powerful. But it does require a very, very, very active trading style. It requires the use of technology. It requires co-location not to have delays or latencies, because if not, other market players will front run you, right? So you place a buy order because you see that on the book, but someone that was on the data center already placed that order. So someone else got the fill, even though you saw the same thing, but someone else got the fill. You were too slow. So you have to be on the same data center. Okay. So again, all of those are very common practices in the marketplace, but typically employed by, again, the large market participants. Okay, so there are other technologies. Okay, I mean, the one I like to use the most, okay, is this one here. Okay, we call that UFOs. Okay, those are UFOs. Again, there are more solutions in the marketplace. Okay, so the fact that this is something that I've developed myself since 2009, actually. It doesn't need to be a reason for you to focus on this only. Do your research, there are more possibilities. But these, of course, they look like flying saucers. So we call them UFOs, and they represent red colors, sell on field orders, green color, buy on field orders. So the expectation is that when price goes to the red, it will fall down. When price goes to the green, it will rally up because the buy orders will change status from on field to field at this price level, and the sell on field orders will change status for on field to field, creating this huge pressure to the downside and moving the markets up and down just because of the order flow. Okay? So we need technology. Again, we need to analyze all sorts of market data, be it prices, ask prices, last prices, volume prices, tick prices, time, day, time frames, ratios, well, how much volume that candle got versus how many ticks, how many up ticks, how many down ticks, how many up volume, how much down volume. I mean, all this type of information cannot be processed by the human eye, even if you had the whole day. We cannot see that on a candlestick chart. You need computer intelligence. It's AI, really. You need computer intelligence to process all that huge amount of data and basically then, yes, very simplistically plot on the charts those price bands, if you wish, where inside the green you buy, inside the red you sell. Okay, but now you know that inside those bands you have on-field orders, which is the direct force. So now let's take a look at another example, and maybe, just maybe, now we get to understand why. So this is now December 9. Okay, December 9, 2004, just a few days before, we have the unemployment number reported 12 p.m. Malaysia time. The prior number was 3.2. Everybody thought it was going to be 3.2, and the report is 3.2, meaning that, okay, well, there is not an improvement on unemployment in Malaysia, but at the same time, it's not like the economy is going worse. We have the same type of number, so, a person could be optimistic about it and say, you know what, that's a good news. Or maybe at least you could say it's neutral. But look at what just happened. With this neutral or good news, the market collapsed pretty heavily. It actually went from the red UFO all the way to the green UFO until it bounced back, starting from the green, right? And again, let me go back. This was the picture that you had at that moment in time. So the indirect force unemployment rate being reported, it's coming out. And as this indirect force is being reported, you look at the market and you're like, oh, wait a moment, I got sell orders. Why? I'm not sure. Is it possible that investment banks or some large market players did their own calculation, had access to information ahead of time, have AI models capable of predicting very accurately unemployment numbers before they are reported? I mean, all of this is yes, and all of the above as well, right? So it's 2025, right? So let's not be naive. I'm not saying that anyone in this group is thinking naively, but let's definitely not be naive, right? And therefore, as probably they knew this was going to happen, maybe they made a lot of money on the way up as an expectation for the news. And like the old saying in Wall Street, buy the rumor, sell the news. So as the news was about to be reported, plenty of sell orders were out in the marketplace. And of course, the news is reported, many retail traders buy, just bringing the prices slightly higher, helping the institutions or the large market players to unload everything they wanted to unload after capitalizing on the move since a few days ago. And then, of course, when no buy orders are left, because the sell orders absorb all the buy orders from the retail participants, which are of a smaller size, next thing you know, market went down. So this, my friends, is order flow in action, and also indirect and direct forces in actions. And this is, by the way, I'm going to call it my interpretation, okay? Because, of course, I am respectful, as I said, to all market theories out there, even though the market is the boss. Market is the Lao Pan, isn't it? So even though that's the case, my interpretation is that's why sometimes you have a good news and the markets fall. That's why you have sometimes a bad news and the markets rally. Is because on the other side of the news, you had the same type or the opposite type of orders waiting to be filled. So the indirect force in this case was unemployment rate. And by the way, I also want to point at something that some of you may have caught by looking at the slide, which is the fact that this is the unemployment number. This is a number that represents the economy. But the chart I have loaded is FCPO, which is crude palm oil futures. Crude palm oil futures. And some of you may be thinking, wait a minute, how come the unemployment number, which is an economical report, affect a commodity such as palm oil? How can that even be possible? What's the relationship? Okay, well, that's the whole thing. That is order flow on top of order flow. Money moves from market to market. When a market is being sold and positions are being closed, this extra availability of capital to trade with goes into another market. And therefore, the order flow that we are discussing in one market actually flows from one market to another one. So that is why you get to see many times economic reports that you would not expect impact some other markets. Because in the end, the money flows from market to market. And one fun way to look at this, okay, maybe I'll do it live here so you can see it. You will see that certain markets present, let me look at correlations, okay, present very changing correlations through time, okay? So correlations mean, for the ones of you that you're not familiar with the term, when a market is correlated with another market, it means they move in tandem. And when a market is inversely correlated with other markets, it means they move opposite. And when a market has a correlation of 0, it means that they just don't move the same. They move totally differently. That's what it means. So let's compare the FCPO with FKLI. Let's compare those two guys from a correlation point of view. Let's apply and take a look how many times the correlation is as high as 75% of the times. Okay, as high as 75% of the times. You know, in December 9, which is the case of our example, correlation was 65%. In other words, tons of money was flowing from FKLI into FCPO or vice versa. There are times whose correlation become negative. And that's then the opposite phenomenon, right? So again, correlations are something that is changing, as you can see, okay? So you could not say, okay, because the correlation is positive, it will always be positive, and FCPO will always move like FKLI. It's not the case. They often move totally opposite, as you can see here, negative correlation of minus 85% or something like that. So, yeah, but it keeps changing. That's the whole point. And changing means flow of orders from one market to another. So again, that's another reason why I'm calling these direct forces, just being pragmatic, because it's the very real thing that moves prices going from market to market. Is us clicking the button and sending orders here and there. You just close a trade with FKLI, and now you open a trade with FCPO, or you just was trading, you know, let's say Tenaga stock, and you just close the trade and open a trade on Maybank stock, you know, just to pick another example. So it's very, very, very relevant. So that's why I'm also calling on employment numbers and economic reports in general indirect forces, because they may or may not help you. They are the reason why orders come in the first place, but you need the evidence that the orders are there to take the trade with higher odds, okay? So instead of a powerful move down, you know, instead of that expected move up or neutral, we had the down move, right? And from there, we saw price travel to the green and then bounce, okay? So despite the fact that on-field orders drive price, it's important to understand and be aware that the current market climate, the environment, the indirect forces, you know, I use the term climate because I used this term in prior webinars. You can always go back and watch some recordings. So those particular indirect forces are tremendously important. So one more time, maybe I'll say it for the last time, I want to emphasize on the importance of indirect forces. They are the reason why on-field orders are there in the first place. But closing your eyes to where the direct forces are, closing your eyes to where the on-field orders are, and just trading just because of the news or other type of indirect forces I'll mention in a moment, would probably lead to problems. So here we have another case. That was December 11. Okay, retail sales number is being reported better than expected, right? And the market went down. Okay, again, is the market crazy? Not at all. At the time of the report, FCPO was trading at 4935, where we got sell orders at 4971. Okay, 4971. So what happens? The buying from the euphoria from the retail public, combined with the fact that large market players don't sell, and that's the key. They don't sell at 49.35. they sell at 49.71. So what happens if you don't sell? Let's say you have a property, right? You have this beautiful house and you sell it at 5 million ringgit, but no one is willing to buy from you at 5 million ringgit. So you wait, and everybody's offering you 3 million. And you're like, no, I'm just selling at 5 million. I'm not selling at less than that. Everybody's like 3 million, but you're not selling at 3 million. You're selling at 5. And then next thing you know, there are news in the market that maybe there is a new scheme, imposed by the government where real estate, is going to go up or whatever, or there will be subsidies for property owners, whatever it is. And next thing you know, now every retail investor is like, oh my God, now it's so much more advantageous to buy. So now suddenly you receive so many more buyers willing to buy, and you're like, okay, 5 million is my number. And maybe there was no trading activity. Let's say there was zero volume. No one was buying. It just took one guy to come meet with you and say, okay, I'll buy you at 5. And the moment the buyer said, I'll buy you at 5 because of the news, you sold at 5, and now price rallied to the red UFO. And from there, tons of selling kick in, and the excess of supply brought the prices down, because now everybody who wanted to buy bought, because there was excess of supply. And when no buyers are left to buy, the only buyers left to buy are buying at 4,840. So then prices would go down, just like when they went up. When no one was selling at this price, only higher, prices went up. But when no buyers are buying at this price, only lower, then prices go down, and they go down fast. Look at the size of the blue candle, look at the size of the gray candle. They go fast because there were no buyers in between. There were no sellers in between. There were no unfilled orders. That's the point. Okay? So the indirect force retail sales suggested everything was set for a move up. Instead, a move down took place, and then it bounced to the upside again. Those are the mechanics of price movement. Unfilled orders have to be filled for prices to move. Okay, and this can only happen when the market is open, by the way. When the market is closed, orders could be canceled, orders could be added, but they will not get filled. So if you're with me on the rationale of everything we've covered so far, then the idea is, okay, why don't we combine them both? Okay, because I'm sure some of you are very much into fundamentals. Some of you are very much into support and resistance. Some of you are very much into FIPS. Some of you are very much into divergences in technical oscillators. Everybody's into some particular technique on how to trade. And let's face it, they all make sense in some way, right? But what about you take that, you call it indirect force, super important, and now you combine it with direct forces. What about you do that? Okay, so let's take a look at some examples of that. Okay, so let's do some exercises here. Okay, so I am going to begin. Okay, and of course, I mean, in a perfect world, instead of today being the 21st of January, today will be the 22nd, which is tomorrow. So we'll be able to, we'll do this live at 12 p.m. and we'll be able to plan a trade in front of the inflation rate, which is going to happen tomorrow. Okay, I mean, you could watch the markets tomorrow at 12 p.m. Okay, I guess that would be an interesting homework to do. Okay, but since I am we're doing this in the evening hours and so on. So what I'm going to do is, instead of calling indirect forces economic reports, like I've been doing most of the webinar, I'm going to call indirect forces support and resistance, for example. Okay, and feel free to type in the chat box. Okay, well, whatever. Well, you know what? I'll ask you this question. Let's do something very, very interesting. Okay, look, this is FCPO in a daily time frame. Okay, and what I'm going to do is I'm just going to hide the chart here, and I'm going to put a line on the chart. Okay, and I'm going to move this up and down. Okay, I'm going to move this up and down because what I'm trying to do here, okay, let me explain what I'm trying to do before I do it so you fully understand me, is I'm going to pretend, because I'm sure some of you are, I'm going to pretend I am a technical analyst looking for support and resistances in the marketplace. And for example, here is an obvious turning point, connected with those bodies there and these potentially highs. Maybe you could argue this would be a better place where to put the line depending on your style. And maybe you're looking at 4408, like a relevant price point in the market. If you are a technical analyst looking at this as a potential resistance, right? So again, I'm looking for resistance and support. I'm going to call them indirect forces, and then I will combine them with with direct forces to make it stronger. Okay, by itself, it's already strong, but we can make it stronger. That's my point. So what I'm going to do to be as random as possible. So because remember, I want to be random because we said indirect forces are subject to interpretation. So I'm going to move this up and down, okay? And I'm just going to stop it there, which is a random place. And now I'm going to see where am I at, okay? And when I do that, oh, look at that, okay? So this is lining up with this support, okay? And this turning point right here. So I guess that you would agree with me that probably someone, 45.99, 46.0, probably at some time in the past or in the present is ready to take a trade at this price level if FCPO was to come to this here because they think this is a technical support. Okay, let's do this exercise again. And instead of I'm the one doing it, what about I hide the whole thing and you can see the price scale here. It goes all the way to 5,200 more or less. So anywhere between 5,200 and 3,700. What about you type a number, whatever number you say. I'll pick the initial 2 proposals on the chat box, just so we don't spend too much time. So we are efficient with the use of the time, so I can do more type of examples. 4,500, okay? So I'm gonna have a line at 4,500, okay? More or less there, and 4,000. Here we go. So here are 2 lines, okay, that based on your interpretation, I'm saying that with full respect, please don't get me wrong, with your interpretation, your way to do technical analysis, this is where your lines would be, and that coincides with some sort of a turning point here and here. So not only is a round number, it does look like a technical support. 4,000 looks very neat here and here and here and here, like a very, very strong technical support, okay? And again, this is your interpretation and it's probably a very valid technical analysis, okay? Even though the point I'm trying to make, and please don't take me wrong, okay? This is just to illustrate the point that randomness is randomness. Look, I'm just gonna move up to the, let's say 3,000, 2,000 price range and randomly, okay, I'm just gonna move this up and down. I know this is far from price, okay, but my point is that I'm placing a line randomly in the middle of nowhere. And let's take a look. I may need to go back in time for a long time here because I went too low. Oh, here we go. Look at that. Turning point, perfect turning point. So here's the problem, right? When we interpret something, it could be a financial economic report, it could be a line on the chart, whatever we do, which implies a manual action, it's subject to interpretation. Okay, and while it has tons of value, I mean, there are people that spend years of their life studying technical analysis, so it has plenty of value. But when you try to implement it, okay, unless you have a specific rule set that makes you 100% mechanical and no subject to subjectivity, next thing you know, there is some sort of a subjectivity component. Now, let's say instead of that, you are doing fibs. Okay, and so this is for the Fibonacci traders in the room. So let's say you are doing fibs and you go from here to here. Okay, so now you have these retracement lines. But some of you may say, wait a moment, instead of from here to here, I go from there to there. And some of you may say, oh, wait a moment, I go from the last swing from here to here. That's how I do it. Right? Some of you be like, well, wait a moment, this is a downtrend. I go in the opposite direction. I go from here to here. So in other words, now you have Fibonacci guys, but all of them have a different interpretation on how to place the lines. Just like you look at the GDP number and everybody has a different interpretation, right? Or some of you are into technical indicators and maybe you love, I don't know, MACD, moving average convergence divergence. And some of you are looking at this and it's like, hey, look at that. This is a bullish divergence because this is making lower lows, but this is now starting to make higher lows, right? And some of you are like, okay, that's fine. That's what I see. But some of you are like, okay, wait a moment. I don't use 12 and 26. I use 14 and 55. And with that, who knows what's going to be. That's not a divergence any longer, right? And so again, nothing wrong with MACD. This is the point. There is nothing wrong with nothing. Everything is valid. Everything brings in value. But the problem is that many times when you try to take a decision out of some of those techniques, an interpretation is needed, and the interpretation makes the application often to be subjective. Okay, and I'm pretty sure that maybe some of you have a very sophisticated trading plan where you have systematic approach to it, and you don't fall into this trap. But I mean, I've seen traders for years and years, so I think, you know, I would be positive that, you know, many of you, you know, could feel that what I'm saying it's basically resonating with you, or you have seen it, or it may have happened to you, or it may be happening to you to this day. Again, I'm trying to help here, pointing at, you know, in this case, the power, but also the potential risk of indirect forces. Whereas if you have done this, right, I'm gonna go back to what you did before. I mean, let me work on the scale so this doesn't move. Here we go. So I'm gonna go back to what you did before. You guys said 4,500. We agreed that it was subject to interpretation. Powerful, but subject to interpretation. Okay, so here's this may be absolutely precise. Coordinate 4,500 and 4,000. Okay, this is what two of you said. So if I was to now turn on technology with the on-field orders, here we go. You have on-field orders to buy at 4,000. You have on-field orders to sell at 4,500. So in other words, here you have an indirect force plus a direct force ready to help you to short, in this case, palm chrome oil. And here, same story. You have an indirect force plus a direct force ready to help you if you were to trade using that UFO, right? So in other words, well, congratulations. Okay, your lines ended up in a place where you know it made sense, but it's not gonna be all the time the case. Let me turn this off again. Okay, and just for fun, let's look at a 30-minute time frame of FCPO, the intraday, for example. And let's pretend that you're a Fibonacci guy. And I'm going to be very precise. I'm going to use the magnet. I'm going to go from the top all the way to the bottom. Okay. And to some of you, 42.11 is relevant. 42.75 is relevant. 43.28 is relevant. 43.80 is relevant. Okay. This is what some of you feel. And definitely, I would feel the same if I was a Fibonacci trader using Fibonacci only. But now when you turn to UFOs, the reality is that none of those lines are that relevant, because there are buy on field orders in the middle of these two Fibonacci lines. There are buy on field orders in the middle of these two Fibonacci lines. There are many on field orders here in the middle of these Fibonacci lines, but there is nothing lining up with those lines. Okay, now, if you rewind a moment ago, there were on-field orders lining up with that Fibonacci line, direct and indirect forces. So if sometime in the past, let's see when the market came back here, see? It did come back, we saw it earlier, here we go. So the market came back into where the sell on-field orders are, which lines up with a Fibonacci retracement line, and look at the reaction and look at the reaction again. And you will be looking at that and it's like, is the Fibonacci line? And guess what? There are many computers around the world that are sending with their algorithmic trading systems sell orders because of the Fibonacci line. So yes, the indirect force Fibonacci in this case, it's the reason why sell on-field orders and new order flow comes in. It is. But the fact that at the time of the trade, let me go back. The fact that at the time of the trade, not only you had the Fibonacci line, which is potential for more sell orders to come in, on top of that, technology picked up the evidence, not the guarantee, of course not, but the evidence that sell on field orders were available. The two things together increases the odds of success. Now, fast forward in time, okay, we do all of that, okay? So this is the end of the chart. Yes, this is the end of the chart. Okay, so let me cancel the replay thing. So now we are at the end of the chart. So now, do we still have a red UFO right there? No, we don't have it anymore. What does that mean? That orders came, got filled, less on-field orders are left. Orders came, more sell orders got filled, less on-field orders are left. Remember, I said it's counterintuitive. I'm thinking backwards instead of forward. It's counterintuitive. Less on-field orders are left. orders came, more orders got filled, less on-field orders are left. Take a look at the subtlety of this. Little by little, this is making higher highs, which means every time it's coming back to here, it's consuming whatever on-field orders were there are being consumed. So guess what the expectation is when price bounces out of these UFOs and come back here, it's gonna go straight all the way to here. I mean, obviously this is not a guarantee because it's the future, but it is indeed a logical possibility given the market mechanics I have been describing today from an order flow angle, which hopefully gets you think about the market from a different angle, thanks to this presentation, which we have just reached its end and is now time for the Q&A. So yeah, anyway, again, so much to talk about and so many cases. Remember, on-field indirect forces can be many things. So I thought of talking about economic reports. I thought about talking about support resistance. I thought about talking about FIBs, but you name it. It could be moving averages. It could be, you name it. The sky is the limit. One thing is the reason why orders may be there in the first place could be a Fibonacci line, because algorithmic systems are plugging orders into the system, or an economic report. A different story is, are there orders there in the real world? Is it only a possibility which is subjective given my interpretation, or are there orders? And again, one last time, my proposal is do it both. Find your indirect force, one or multiple indirect forces, line them up, and then add UFOs, either with the technology I'm using here today, or any other technology available out there in the marketplace that could help you to spot on-field orders.